to today's explainer. Look, we have got a massive, high-stakes docket to rip through today. Between geopolitical shockwaves, completely divergent central bank data, and a relentless marathon of economic releases, global markets are quite literally operating at maximum intensity right now. If you're trading currencies or equities today, you're navigating a very complex landscape. So let's jump right into exactly what happened overnight and map out the crucial technical levels you absolutely need to watch. Okay, let's dive into this. Geopolitics remains the market's absolute favorite headache. Overnight, President Donald Trump stated the U.S. is in the final stages of talks with Iran, but he added a massive caveat: military action remains firmly on the table. It's basically diplomacy with a side of intense suspense. Iran noted they've used the ceasefire to rebuild their strength, while China's President Xi called for restraint all around. Meanwhile, Iran's new Persian Gulf Strait Authority just announced tighter shipping controls through the Strait of Hormuz, and the U.S. military actually redirected an Iranian-flagged tanker in the Gulf of Oman. Right now, oil traders are treating every single headline like a live grenade. Here is our action map for today's session. We'll be looking at the overnight macro and markets, central bank actions, the PMI marathon, currency technicals, the USDINR spotlight, and finally, we'll wrap up with a Nifty spotlight. Starting things off with Section 1, overnight macro and global markets. So Brent crude has actually steadied out right around $105 per barrel. That comes after tumbling more than 5%, specifically on the back of Trump's comments about nearing a deal with Iran. But with those shipping controls in the Strait of Hormuz acting as a massive wildcard, the energy markets remain incredibly hyperreactive. The floor is holding for now, sure, but the supply chain anxiety, you can literally feel it. Now, while oil cooled off a bit, Wall Street saw a pretty sharp rebound. The Nasdaq surged 1.5%, the Dow gained over 645 points, and the S&P 500 rose 1.1%. We also saw the 10-year Treasury yield pull back to 4.58% after touching a 16-month high just in the prior session, and naturally, the US dollar pulled back from its 6-week highs as safe haven demand cooled off just a touch. But make no mistake, markets are still heavily cautious that a prolonged geopolitical conflict could keep inflation elevated. Traders might have taken a quick breather yesterday, but honestly, not enough to leave their screens unattended. Moving into Section 2, geopolitics and central bank actions. Okay, the fresh Federal Reserve minutes definitely striking a much more hawkish tone than markets were banking on. Policymakers are expressing some deep structural concern that war-driven inflation could really become entrenched in the economy. In fact, several members appeared increasingly open to even further rate hikes if inflation risks worsened. So the Fed is keeping the door wide open, really cementing this higher-for-longer reality. And this brilliantly illustrates the massive divergence we're seeing across the Atlantic right now. Over in the UK, CPI cooled down to 2.8% year-over-year in April, which actually marks the lowest reading since March 2025, largely aided by softer housing and energy costs. But crossed the channel into the Eurozone, and CPI just accelerated to 3.0%, the highest since September 2023, largely driven by energy and services. As a direct result of that hot print, the euro immediately weakened. Which brings us to Section 3, today's catalyst, the PMI marathon. Today's data docket is seriously going to test market resilience. We're looking at a chronological barrage of manufacturing and services PMIs, starting with France and Germany, moving into the broader Eurozone in the UK, and capping off with US PMIs, jobless claims, and the Philadelphia Fed Manufacturing Index. Throw in speeches from the Bank of England's Andrew Bailey and ECB official Frank Elderson, and you have colliding inflation, growth, and geopolitical data that is practically guaranteed to spark immense intraday volatility. All right, let's get into the tactical side with Section 4, Global Currency Technicals and Views. So the crucial point here is understanding the fundamental forces actually driving these charts. The dollar index, the DXY, continues to be supported by remarkably strong U.S. economic numbers despite the war overhang, and today's U.S. PMIs are going to serve as a massive leading indicator. Meanwhile, the Euro-USD is being heavily pressured. Even though Germany's 10-year Bund yield climbed down from a 15-year high, the market is currently pricing in an 86% probability of a June ECB hike, all thanks to that hot 3% CPI print. Tactically speaking, here are your battle lines for day trading. The DXY remains a firm buy on dips. You're looking at immediate resistance up at 99.64, with solid support lying at 99.00, and then down at 98.71, which was yesterday's high from where the index had previously retraced. Conversely, the EUR-USD structure remains a sell-on rise. Watch for heavy resistance parked at 1.1654, with your downside support target sitting at 1.11612 ahead of today's manufacturing and services prints. Now, what about the pound and the yen? Well, the GBP/USD recovered sharply late yesterday on Trump's comments and got an extra boost as the UK 10-year yield fell more than 15 basis points to trade below that psychological 5% level, definitely aided by that cooling 2.8% CPI. The USD/JPY, however, is a fascinating game of chicken. Japan's Q1 GDP beat expectations at positive 0.5% quarter over quarter, and Japanese trade numbers beat this morning, keeping their 10-year yield near 2.79%, which is its highest since 1996. Yet the pair just continues to march upward, facing massive Bank of Japan intervention fears as it flirts with that 160.00 level. So what are the key battlegrounds? For GBP/USD, despite the recent boost, the broader structure remains sell on rise. Your resistance is clustered at 1.3450 and then the 1.3470 weighted moving average, with support down at 1.3393. Definitely watch the UK PMI numbers closely here. For US/JPY, traders are going to really test the Bank of Japan's resolve. The view is buy on dips, looking at support at 158.35, with upside resistance stepping up at 158.93 and 159.77. Next up is Section 5. A spotlight on USDINR technical levels. The rupee has just plummeted to a fresh, dramatic record low, closing at 96.82 against the dollar, down from 96.54. Stalled U.S.-Iran peace talks and those elevated global oil prices have kept currency traders on maximum defense. Now, while the Indian bond market was actually relatively calmer, the 10-year yield eased 3 basis points to 7.0761%, the currency itself is completely absorbing the brunt of this global shock. Technically, this pair is incredibly stretched right now. The initial target of 96.90 is effectively done. Because it is highly overbought, the tactical view is to buy only on a significant dip, or if we see a confirmed break of 96.90. Look, if that 96.90 ceiling breaks, it opens the absolute floodgates for a rapid move up to 97.80. On the downside, your defensive supports sit at 96.18 and then 95.89. And wrapping things up with Section 6, spotlight on Nifty and Indian equities. Now, what's really interesting here is the sheer scale of the capital flight. Overseas investors have sold a staggering $23 billion worth of Indian shares so far in 2026. That already surpasses the record annual outflow seen all of last year. Rising global borrowing costs linked to the Iran conflict are heavily weighing on sentiment, meaning that even when we get a green close, the foundational strength just isn't there. The Nifty 50 did manage to gain 0.17% to close at 23,659 in a very volatile session. The gap down was actually bought into quite smartly, with key support at 23,439 holding the line. The Nifty Midcap 100 also gained 0.5%. However, the overarching structure remains a sell-on rise. Crucially, due to vastly diminished momentum support, this is strictly a market for nimble, intraday traders right now. Your immediate supports are 23,576 and 23,439, while your upside resistance hits a brick wall at the key level of 23,796, followed by 23,900. Which leaves us with a provocative final thought for today's session. With inflation diverging, oil acting as a total wild card, geopolitics shifting by the hour, and a massive marathon of PMI growth data colliding all at once, are you disciplined enough to trade the prevailing trend and respect the technical levels we just mapped out? Or are you going to get caught simply treating the chaotic headlines? Stay sharp out there, manage your risk closely, and we will see you next time.